Building your financial dream. Home equity loans. Another popular option that problematic debtors often consider is the home equity loan. These loans may help you to reduce the interest rate that you are currently paying on your debt, but you must put up your home as security on the loan. One of the major advantages of obtaining a home equity loan is the fact that the interest paid on the loan may be tax deductible. This can add up to substantial savings on your taxes. Another advantage of obtaining a home equity loan is that it is often a very easy loan to obtain. When faced with debt problems, consumers often fall behind on their credit card, utility, and loan payments. This negatively affects your credit rating, making it more difficult to obtain a loan. Because a home equity loan is secured, the lenders have less of a risk in loaning you their money. If you default on the loan, your house can be taken away from you. This obviously is the biggest disadvantage. How to find and become a member of a credit union. Almost every major organization and large employer has become affiliated with a credit union. Therefore, you may be able to join a credit union through your employer. However, if you're self-employed or work for a small company, you may be able to join a credit union through a sponsorship from a relative. Characteristics of smart checking. As we previously discussed, your checking account is one of the most frequently used banking services. So it is important that you obtain the best checking account that fits your needs and is easy to manage. You should look into the following things as a part of your selection process. Be sure that your checking account offers interest on your balance. Many bank and most credit unions will pay an interest rate on your checking account. What are the fees associated with having an account? Ideally, you want to locate a bank or credit union that charges no fees. What is the minimum account balance that must be maintained? Many banks will charge a fee if the minimum balance is not maintained. You should avoid this because, as stated earlier, credit unions have a no-fee policy. Are the branch locations and hours of operations convenient for you? Can you check your transactions and account balances on the phone, after hours, or online? Are there any per check charges? Some banks charge you a fee per check, while others give you a limited number of checks per month. Be sure that your checking account has no check charges. Does the bank offer over-free draft protection? This means if you exceed the amount in your checking account, the bank will cover the check and you have to owe them an amount. Credit cards. What to look for and what to look out for. Through the introduction of credit cards, people no longer needed to wait for a paycheck to make purchases. Now they can use credit cards and pay for purchases over an extended amount of time. How do credit cards work? When you use a Visa or a MasterCard, a series of steps happens to ensure that your account is charged and the merchant receives payment for the charge. Number 1, the customer gives credit card to the cashier when making a purchase. The cashier swipes the credit card through an electronic approval machine, which is connected to a credit approval bank. When the customer signs a receipt, he or she is agreeing to pay for the charge. The merchant deposits the receipt in his or her bank account and receives a credit of 99% of the receipt amount. This transaction is sent electronically to Visa, MasterCard, American Express, etc. Visa, MasterCard, or American Express processes the transaction and credits the merchant's bank and debits the card's insurer's account. Visa, MasterCard, American Express electronically notifies the card issuing bank that the transaction has taken place. The card issuing bank bills you for the purchase. Why do most credit cards carry the Visa, MasterCard symbols? Many people do not know that Visa and MasterCard are associations that handle both credit card transactions. They are both not-for-profit organizations and are owned by member banks that issue the cards. These associations work closely together to make most banks or merchants that accept them are usually accept others. Understanding your credit card statement. Most banks issuing cards often offer their customers a detailed, itemized monthly snapshot of account activity. Included in the monthly statements are the current balance, the total credit line, available credit, previous balance, the cash withdrawals, finance charges, credits, charges, payment due date, cash credit limit, statement closing or billing date. Keys to look for in a superior credit card. You can minimize or even eliminate many expensive credit card fees and interest rates if you choose a card suited for your needs. However, all credit card insurers are in business to make money, so beware if you maintain high balances, you will be charged accordingly. Choose a card with no annual fee. Annual fees are yearly charges for using a particular card. These charges can range from $29 to $99 per year and are automatically charged to your account. However, there are many cards that guarantee no annual fee for as long as you can own the card. Find a card with low finance charges or APR, annual percentage rate. Finance charges are the costs added to your account for using your card. Included in the finance charge is interest, late fees, and usage charges. Many insurers are charging between 18 and 25% annual interest rates on purchase balances. As an incentive to use their card, many of them offer introductory rates with low interest for a specific period. These so-called teaser rates can be as low as 2.9% for a limited time. Be sure to read the fine print and details to ensure that you may take advantage of these low rates. Find a card with a low grace period. Grace period is the time between your purchase date and your payment due date, provided that you pay your balance on time each month. You will not be charged interest during this grace period. Therefore, you can receive an interest-free loan every month when you use a card. The moment you incur a balance on your credit card, you are no longer allotted an interest-free grace period. Card incentives. As an incentive to use a particular card, many insurers will offer a quick kickback or refund all of your purchases. Some cards offer free airline miles, discounted automobile purchases, free gasoline, or up to 2% annual bonus award. Many of these programs can actually be very valuable incentives, but remember to only consider available incentive options after your card has been comparably shopped in regards to annual fees, finance charges, and grace periods. Additional privileges to look for. To attract new customers, many credit card companies offer special membership or privileges to their cardholders. Many of these added bonuses include, but not limited to, shopping or travel discounts, airline bonuses, travel insurance, rental car insurance, extended warranties, and year-end statements. Credit cards to avoid. Avoid credit cards with a high APR. Number 2, avoid credit cards with high late fees. Number 3, avoid credit cards with no grace period as explained in the prior section. Number 4, be careful with variable rate credit cards. Credit card safety tips. To ensure safety of your account and to prevent possible identity theft and fraud or card misuse, please adhere to the following guidelines. Be sure to sign your card as soon as you receive it. Treat your card as cash. Never leave it unattended, and remember to retrieve it after each and every purchase. Choose a unique and unobvious PIN number and memorize it. Never disclose your PIN to anyone, not even the police or a merchant should ever know your PIN. You are the only person that should know it. Always keep your sales receipts and credit card vouchers. Make sure to compare them to your statements every month. Avoid giving your credit card number over the phone unless you trust the reputation of the company. Make a record of your credit card account numbers and telephone numbers for reporting loss or stolen cards. Keep this list in a safe place, preferably a file safe. Understand your credit card billing method and how you will be billed. With many credit cards, interest applies from the original date of purchase. Protecting your credit card rights. To protect borrowers from being taken advantage of by the credit card companies, the federal government has legislated 2 acts to address these concerns: the Fair Credit Billing Act and the Truth in Lending Act. The Fair Credit Billing Act established procedures for resolving credit and card billing errors. The bill guarantees certain credit card rights to all holders. Home financing. Owning a home ranks very high on America's list of financial goals. In fact, most children will tell you exactly what kind of home they dream of, even before they have a clue about a career goal. It is not surprising that nearly 65% of all Americans will eventually own their home at some point in their life. Advantages of owning a home. You will build equity in property, which you can eventually sell or for a profit. You can deduct mortgage interest and property taxes on your tax return. You may be eligible for a tax deferment when you sell the property. You will have additional space for less money. You may borrow money from the equity in your home. You can change, alter, or make improvements as you like. It's an excellent investment that allows you to amass wealth. This is a good kind of debt. Purchasing a home through a mortgage allows you to use banks' money to purchase property that will hopefully rise in value. Let's take a look at an example. Mike and Tina began looking to purchase their first home 3 months after they were married. They had $30,000 to use as a down payment and understood that they could only afford a $150,000 home. After a few weeks, they found a home that they both loved. The seller was asking $175,000 for their home and was motivated to sell based on a recent job transfer. Mike and Tina knew the house was worth $175,000. They offered the seller $150,000 and were surprised that their offer was accepted without a counter. They used their $30,000 for down payment and took out a mortgage for $120,000. Mike and Tina made some minor improvements costing around $5,000 and moved into their first home together. After 3 years, Tina was pregnant with their second child, and the couple felt like it was time for a larger home. They decided to attempt to sell their current home and began investing in the selling prices of comparable homes in the area. After having a home appraised and meeting with a real estate broker, the couple put their home on the market for $270,000. It sold within a week for their full asking price. They had made a profit of $120,000 in 3 years from an initial investment of $35,000. Should you continue to rent or can you afford to buy? What measures determine home affordability? Mortgage lenders have traditionally expected borrowers to have a housing expense ratio of 28% or less. The housing expense is an indication of a borrower's ability to make the payments on their mortgage loan. The ratio measures housing expenses as a percentage of gross income. For example, if the borrower's salary were $4,000 per month, a lender would approve their loan if the housing expense, mortgage payments, fire insurance, and property taxes were less than $1,120 a month, or equivalent of 28% of income. When you begin to consider purchasing a home, it is wise to look carefully at your finances and determine if your purchase would be sensible. The first thing to consider is whether or not you have enough available cash to use a down payment. Usually banks and lending institutions require 10 to 20% of the purchase price as down payment. Next, you must determine if you will be able to finance the remaining price of the house. In general, banks and lenders will qualify borrowers when their monthly housing expense is no more than 28% of the gross monthly income. Before making a decision on whether to purchase a home or continue renting, it will be very wise to contact a mortgage lender and request a pre-approval amount. Your lender will be able to determine your maximum lending amount, along with an estimate of your monthly payments before taxes. With this amount in mind, you can begin to shop for your homes in your area. Because the interest paid on the home mortgage is tax deductible, homeowners usually can take a substantial income tax savings after purchasing a home. This deduction obviously will reduce the monthly cost of owning a home and should be considered when deciding to buy a home. Often when new buyers are considering purchasing a new home, they overlook the additional financial responsibilities that are involved with owning real estate. Some examples of expenses that are likely to encounter are as follows: home insurance, property taxes, maintenance, how to find the mortgage that is right for you. There are generally 3 types of mortgages that are available in most situations. There are the fixed mortgages, adjustable rate mortgages, or the combination of both called the hybrid mortgage. Let's take a closer look at each of them. Fixed or conventional mortgages. These are the most traditional types of mortgages and have been available since 1930s. A constant interest rate, points, and other fees characterize these mortgages. With the fixed mortgage rate, the borrower can expect to pay the same monthly amount payment for the life of the loan. Additionally, fixed rate mortgages usually include points when the loan is originated. A point is 1% of the loan amount, which is due up front, usually at the time of closing. Your interest rate and points are related, as your interest rate can be reduced over the life of the loan by paying up front in the form of points. Therefore, you may consider points as another form of down payment, as the advantages are the same. When you pay cash up front, you enjoy the benefits of a lower interest rate over the life of the loan. Adjustable rate mortgages. An adjustable rate mortgage, or ARM, is characterized by a varying interest rate and low initial interest rates. This works in your benefit when interest rates are falling. However, it can be costly in a climate when interest rates are rising. Every ARM begins with initially low teaser rate. This helps reduce your closing costs in early monthly payments. Additionally, your interest rate could drop if the interest rates drop. How ARMs work. An ARM has a variable interest rate. However, your interest rate can only change in a regular schedule. For example, once a year. Your rate will change to reflect fluctuations in the cost of borrowing or the index. Your lender will determine your new rate based on 2 measures: the index, the measure of prevailing interest rates of securities like U.S. Treasuries. The margin. hundreds of percentage points added to the index to determine your rate. Cap costs. All ARMs have caps or limits on the amount of the interest rate they can charge. And an annual cap limits the rate change each year, while the life cap limits the cap over the life of the loan. Beware of the ARMs that allow negative amortization. This is when the borrower may owe money at the end of the loan if the interest rises above your lifetime cap. Warning, ARMs can be classified as predatory lending. Subprime lending and ARMs were the chief cause of mortgage meltdown of 2007-2008. Hybrid mortgages offer advantages of fixed rates and adjustable mortgages. These loans offer an initial fixed rate with the option to change to a lower amount if it becomes available. Fixed rate mortgages. Advantages. You will always know your closing costs, your housing costs. Your mortgage will not increase if the rate goes up. Disadvantages. Initial rates and closing costs are higher. Monthly payments may be larger with an ARM. You will not benefit if the interest rate drops. Adjustable mortgages. ARMs. Advantages. Low initial rates. Teaser rates reduce your closing costs and early monthly payments. Your interest rate will drop if the interest rate goes down. Disadvantages. If the interest rate increases, so does your payments. You may not have the benefits of a low locked-in rate. Choosing the right mortgage. The purchase of a home is often a large investment of your life. Therefore, it is wise to shop around for the best loan or mortgage for you. Remember, it is essential to find a lender who you feel comfortable with, who is also knowledgeable and highly recommended. Be sure to contact at least 3 lenders and comparatively shop your loan. Type of investments. There are 3 categories of investments that individuals can make: stocks, bonds, and money market cash. In these categories, you can invest directly or indirectly by pooling your money with others into a mutual fund. Let's take a look at each of these investments individually and examine the risks and rewards of each. Stocks. When you purchase stocks, you exchange your money for your share of the stock or ownership in that company. Your hope as an investor is that the company is successful, profits and earnings grow, and the value of stock rises. However, if the company suffers from financial difficulties, the stock prices are likely to fall. A stock has no absolute value. The value depends on what the market is willing to pay for it any particular day. Additionally, because the prices of stocks fluctuate, your goals as an investor are to buy low and sell high. One additional feature of owning a stock is the opportunity to earn dividend payments while you own the stock. If the company is doing well and making a profit, you may receive a part of the profit as dividends. This can turn into a source of additional income for the stock owner. Traditionally, stocks have been the best investments over time. That is because when you purchase stock, you purchase equity in a company, which is why stocks are sometimes called equities. Again, if the company is successful, being part owner of the company will also be successful. Investing in stocks help both the investor as well as the company, as you are actually loaning your money to the company to be used towards business. If your objective as an investor is to grow capital or accumulate wealth, then investing in stocks is probably your best vehicle. However, there are no guarantees that your stock prices will increase or that the company will invest in will continue to do well. Additionally, there is the possibility of losing money in the stock market. These risks can be minimized by becoming an educated investor and by seeking the assistance of qualified financial planners. In the next few sections, you will examine your risk potentials. Bond investment, U.S. Treasury notes and bonds. Pension, deductible pension or retirement income received by a claimant under a plan maintained by a base period employer. Benefits are reduced by pro rata amount based on the pension received in the base period employer, contributing to the amount to the pension or retirement plan. Social Security benefits are not a deductible pension. When a person invests in bonds, they are loaning money to corporations or governments. They are not, however, purchasing ownership in the corporation or the government. As a holder of the bond, you become a creditor of a company or the government you borrowed from, or who borrowed your money. Bonds can be attractive investments as they usually pay interest income and specify the maturity amount to the investor. These fixed income securities also pay interest on a regular basis, which can be an excellent source of income for the investor. Bonds are considered to be safer than stocks and represent a moderate risk investment. When you purchase stock, you exchange your money for shares. However, government-sponsored bonds, which usually cost around $1,000 and up, have lower interest rates than corporate bonds. but represent the highest security as the U.S. government backs them. U.S. Treasury bills. These are characterized by short-term securities up to a year in length. Treasury bills can be used as an interim holding place for cash. The interest earned is the difference between the discounted buying price and the maturity selling price. This is a very safe investment backed by the U.S. government. Corporate bonds, an asset-backed bond. Asset-backed bonds, also known as asset-backed securities, are secured by loans or by money owed to a company for merchandise or services purchased on credit. For example, an asset-backed bond is created when a security firm bundles debt such as credit card or car loans and sells investors to the right to receive the payments made on the loans. U.S. Treasury securities such as bills, notes, and bonds are debt obligations of the U.S. government. When you buy a U.S. Treasury security, you are lending money to the federal government for a specific period of time. Because these debt obligations are backed by the full faith and credit of the government and thus its ability to raise tax revenues and print currency, U.S. Treasury securities or treasuries are generally considered the safest investments of all. They are viewed in the market as having virtually no credit risk, meaning that it is highly profitable and probably your interest and principal will be paid fully and on time. Because of this unique degree of safety, interest rates are generally low for this class of securities than for any other widely traded debt. Riskier debts, securities such as corporate bonds, a good rule of thumb is that safer investments offer lower returns. Conversely, the higher the risk, the higher the return. Money market or cash investment. If your investment objective is to keep your principal safe and free from shrinkage due to inflation or mortgage loss, then the money market investment may be your best choice. The money market consists of investments including government bonds, specialized bank saving programs, certificates of deposit, saving accounts, and even checking accounts. These type of investments may have very short or long-term maturities and usually represent investment possibilities. When you deposit $1,000 in one of these investments, you are quite confident you will have at least $1,000 next year. With other investments, you cannot be so sure. Therefore, money market investments have stability as their primary investment objective. Government bonds are also considered to be money market investments as they are one of the safest investments that an individual can make. However, they usually do not pay an excellent rate of return on your investment. Usually government bonds will pay a few percentage points above inflation because they are considered relatively risk-free. It is used by many investors to protect their investments. Mutual funds. Mutual funds have become a household name for millions of investors throughout the world. With over 11,000 mutual funds to choose from, investors have made mutual funds the first investment that most new investors seek. What is a mutual fund? Mutual funds represent a pooling of money with other investors who share a common objective. This pooled money is managed by a fund manager who has identified investments that are likely to produce results. The fund manager may choose to invest the fund of stocks, bonds, or money market investments, but they are likely to hold a diversified portfolio of many investments. Therefore, when investing in a mutual fund, you are automatically diversifying your investment across the fund portfolio. When you invest in a mutual fund, you are given shares in the fund. As the value of the stocks, bonds, and money market investments increase within the fund portfolio, so do the value of the shares you own. Likewise, if the value of the fund, stocks, bonds, or money market investments falls, the value of your shares will also. Why are mutual funds an attractive investment? Beginner investors have a fund manager who will invest their money wisely. As convenient as using a bank, investors can make regular deposits through mail, automatic deposit, or regular installment deposits into the funds. Your money is automatically diversified through many stocks or bonds. Mutual funds are liquid assets, safer than owning individual stocks but higher return than banks. Mutual fund companies usually can offer assistance in understanding your account. Many different types of funds. An investor can own many different types, allowing additional diversification of investments. Understanding risk and developing your investment strategy. All investments involve some kind of risk and opportunity cost. Even the safer investments include saving accounts. Involve the risk that your money will grow at a rate that is slower than the rate of inflation. Investing $100 in a savings account today may yield $103 next year. But if the inflation rate is 4% per year, your $103 will be less than $100 today. Therefore, your safe investment into a savings account may actually result in an asset loss for you. Additionally, when you make one particular investment, you are also risking the opportunity that another investment may bring. For example, investing $100 in a 3% interest, you are actually risking or losing the opportunity to invest $100 in a stock that may increase the value by 25%. The opportunity cost of investing in a savings account is additionally interest or growth that you may have earned if you invest in stocks. Therefore, all investments involve some risk. Financial planning. It's never too late to start. Step 1. The first question that comes to mind for most people is, I can't afford to invest. The answer is, you can't afford not to. There's no minimum setup amount to begin. You can begin with as little as $50. Consider this. Number 1, your earning potential is greater, and so is your risk. Number 2, the younger you are, the more risk you are able to take. Number 3, your goals will vary depending on your age and your stage of life. Step 2, make sure to stay within your plan. If you're not sure what your plan should contain and would like more professional advice on investing, you should contact and hire an investment professional. Get as much information as possible up front prior to your first consultation, as this is the area where you need to qualify that person based on several considerations, including their experience, education, and expertise in the field. Their reputation from current investor clients they have is important. Also, be sure to contact some of their existing clients and ask for feedback about their investment abilities. Understanding your investment risk reward limits. There's an old saying that most investors use a rule when examining investments. The greater the risk, the greater the reward. To help you understand this rule, think about playing the lottery. If you make a minimum investment of $1 to purchase a lottery ticket, the likelihood of losing that dollar is quite high. In fact, many people forget to check and see if they won. Actually, most people don't expect to win. Therefore, the risk of losing your investment $1 is extremely high. However, the return on your investment, the jackpot, if you win, could potentially be hundreds or thousands in rewards. Basically, the greater the risk, the higher the potential for a return investment. Age and time as a determining factor. Many investment professionals recommend higher risk or more aggressive investments to young people that are just beginning to invest. When an investor has many years to invest, he or she is more likely to recover from the effects of any downswings or declines in their investments. However, an investor has a shorter investment timeline. Conservative and secure investments may offer the stability and security of maintaining your principal, building your personal investment plan. As with any goals, reaching your financial goals requires the development of an effective, comfortable, and workable investment plan. This section outlines important characteristics of a successful investment plan to assist you in optimizing and maximizing your investment success. Commit to making regular deposits or installments into your investment. Decide on an amount that you can invest in your account on a regular basis and make the payment your first priority. Many investors find it easiest to have their investments directly taken out their paycheck. In this case, the money never goes into their account to be spent on other ways. Many investing professionals investing 5-10% of your income before paying bills, buying food, or paying any other expenses. This will ensure that your investment account is growing regardless of the changes in your regular monthly expenses. Whatever the amount of your regular investment, pay it first and make it a habit. Develop a diversified investment portfolio. If you develop a diversified investment portfolio, you eliminate the possibility that a decline in any one investment market or asset will substantially reduce your wealth. Although the market is constantly changing and some of your investments may be in decline, you can be confident that you have other investments that are performing well and making significant gains. Be sure that your investments cover stocks, bonds, money markets, and real estate. Only then you can be sure that you have the coverage to ensure growth. Reinvesting your earnings and interest. Remember the power of compound interest. Reinvesting the income generated by your investments is a sure way of growing your investments for the long run. If you don't require this income to live, have it automatically reinvested to grow your capital. Have patience with your investments. Be successful with your investments. You must have the patience to weather the storm and hang in there. Making emotional decisions during a market panic could cause you to realize substantial losses. Keep your long-term goals in mind and have patience. Consolidation loans. The average family holds over 9 credit cards and carries an average balance of just over $5,000 in total credit card debt. For people who are troubled with problematic debt, $5,000 might be your average balance on each year of your cards. With credit card interest having around 7 to 36% interest, the thought of consolidating your credit card balances within a low one monthly payment can be very attractive. It could even simplify your payment schedule, as you should only have one payment to make. Sometimes it might even be the most logical step into eventually eliminating your debt. Although borrowing additional money to pay off your loans may seem like a good idea, it can sometimes be quite dangerous. In fact, sometimes you may be trading unsecured debt for secured debt. If you are ever in trouble with debt again, you may lose your home, furniture, car, and other assets. Therefore, before taking an additional consolidation loan, consider the 5 refinancing rules. Rules of debt consolidation. Number 1, I am going to stop buying on credit. If you cannot honestly answer yes to this question, refinance is definitely out of the question. If you haven't solved your problematic in debt from Chapter 1, a consolidation loan will only make matters worse for you in the future. Number 2, will a consolidation loan reduce your overall debt load? Sometimes a credit consumer service will actually collect your check, and for a small charge, at least 10%, they will very kindly pay all your bills for you. They step in and act as a bookkeeping and accounting service for you. With the additional 10% fee that you are paying for service, you are actually increasing your debt load. Number 3, don't refinance your car loan to your home mortgage loan. When in fear of losing their automobile, many debtors may consider rolling their car loan into their new home equity or second mortgage loan. Number 4, almost never refinance unsecured debt into secured debt. Of course, this may be the easiest way for you to get an additional loan, but it can be almost dangerous. For example, do not take out a second mortgage on your home to pay off your credit card or utility bills. These unsecured creditors do not have any rights towards your assets at this time. But if you refinance or consolidate your loans, involves your home as collateral, you'll be facing the loss of your home if you continue to experience financial difficulties. Having creditors harass you for a payment and make derogatory remarks against your credit report is bad, but having your home foreclosed on is much worse. Number 5, consider more than just the interest rate when you're looking at a new consolidation loan. Other fees and charges, which may seem hidden, can be dramatically increase the actual cost of the loan. Be sure to add fees that you will roll into your new loan to initiate fees and penalties you may pay to add to old lenders. Types of consolidation loans. Low interest rates. As an alternative to paying high interest rates on many credit cards, you may look into transferring your balances to low interest rate credit cards. These credit cards companies may entice you to consolidate all your debt into their credit card for as little as 2.9% interest. Wow, that is lower than any home mortgage or bank loan anywhere. Unfortunately, the rate rarely stays that low for very long. Many debtors are attracted to the initial rate and transfer much of their accumulated debt onto that particular credit card. Then, after a fixed amount of time, your interest rate climbs to the same high rate that you enjoyed before acquiring this new card. The problem with this gimmick is that the interest rate only lasts for about a short amount of time and not anywhere near the length you will need to pay your debt off at that low rate. In effect, you have just transferred your debt to another lender. Bill consolidation loans. Unsecured bill consolidation loan can be an effective way to get your finances under control if you can obtain it at an interest rate that is lower than what you're currently paying on your credit cards. It would not make any sense to roll a low interest rate into a high interest rate loan. It may be difficult to obtain a low interest rate unsecured loan if you have suffered from negative effects of a poor credit rating. Although they offer convenience and opportunity to make lower monthly payments, don't be fooled into borrowing money at a rate that is higher than what you're currently paying for the convenience that the loan may bring. Essential tools and resources. Financial facts. Next time you are in the supermarket, department store, and a gas station, count the number of people who are paying for purchases with their cash or check, and count the number of people who are paying using credit cards. Many people would be surprised to learn that over 50% of retail purchases are made by credit cards. This is in complete contrast to how business took place as early as the 1960s and 70s. What do I do now? Anytime that going into debt will allow you to make money for yourself or allow you to make a purchase that increases in value and a substantial discounted price, then using credit to make a purchase is likely to be a good reason. When credit bureaus sell your good name, credit reporting agencies do not need your permission to allow another person or business to see your credit file. The Fair Credit Reporting Act allows anyone with a legitimate business need to gain access to it. How does this legal loophole affect you? Credit bureaus now routinely repackage the information in their files and sell it to businesses to use the data to solicit customers. For most common example is of the practice of pre-screening. A credit card company pays a credit card bureau to search the files and compile a list of people who have type of financial profile the credit card user seeks. It then uses the information to send out offerings of pre-approved credit cards. Many policymakers believe credit bureaus should be required to notify customers so that they can reject pre-screening. If you want to stop the flow of pre-approved credit card propositions to your mailbox, you can write to the major credit bureaus and invest that your file not be used for pre-screening. By law, they must carry out your instructions. Leave your debit card at home. Try it. It works. One thing that I do is I always take a certain amount of cash with me for that week. For example, if my wife and I are grocery shopping, we might only take $100 to the grocery store. Now, if we overspend on our debit cards and are left at home, so we can shop wisely. We have to. Having a card on you always make you exceed your budget. It takes discipline. Having cash in hand, always budget wise shopping. I am Chauncy Williams, and this is the book, What Do I Do Now? Credit, Debt, and Planning for Your Financial Success. Whether you have questions about credit repair, debt management, buying your first home, buying your first car, or preparing your retirement, this is the book for you.